Welcome to the DeFi podcast, where we attempt to imagine the future of crypto because foresight is what makes great investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment. All statements made by hosts or guests are strictly beliefs or point of views and are not recommendations to buy, sell, or hold any security. Hosts or guests may hold certain securities discussed in this podcast.
Hey everyone, this week we have Anthony Zhang on the podcast from Chicago booth. We're going to discuss what's happening in the market right now. Welcome, Anthony.
Great, very, very happy to be here, and very happy to talk about some of the crazy stuff that's happened in the past week or two.
Yeah, thanks for coming on. It's an interesting week.
It is, yeah. I've been basically glued to Twitter. I haven't gotten that much stuff done. It's just been every day something blows up, and it's just, man.
Yeah, Jared, do you want to walk us through sort of the different steps of what's happened over the past couple of weeks, and then we can stop, Anthony, wherever you sort of want to stop and discuss? Maybe a quick overview.
In the last couple of weeks, we've seen UST just blow up. Luna went to, diluted to I think trillions of coins. And then we saw the sort of crypto market start to have some big sell-offs, which I think was basically the thing that triggered Celsius having some serious liquidity issues and potentially becoming insolvent. And then 3 Hours Capital having pretty much the same thing happen where they're going basically insolvent. And then we also have some stuff happening with Solana, which, anyone could expect that to happen.
So Anthony, which part of this whole story do you find most interesting?
I think it's all kind of interlinked, and I think there's a couple of themes to everything. And I think the broad theme of everything is contagion and sort of the non-transparency of the links between parties. And I think these are kind of classic themes. You really see similar things happening in 08, I think is a good comparison. And I think that's kind of the thing that ties everything together. Yeah. I can go more into detail in that if that sounds...
Yeah, I think that's pretty true. I don't think there's a lot of very visible information about what's happening between, did the Celsius problem trigger the 3AC problem, or did it have vice versa? And then there's some, potential, is BlockFi kind of involved as well? Or is it just that the market's going down and so everyone's having problems, and because one person is having problems, they're needing to, liquidate some of their assets, which is just causing the market to make other people have to liquidate their assets. So just a domino effect.
No, that's exactly, I think, nobody really knows. I think that's the problem here, or that's kind of what makes it so scary what's going on, and it's actually very analogous to what happened, I think, in 08. And I think sort of, if you look at 08, it's kind of a similar thing, where it's it really took a lot longer in TradFi to kind of unravel, right? 06, kind of, I think Fed raises rates, and then sort of house prices start slowing down, right? People start noticing that a couple mortgages are starting to default more, and then a small segment of mortgage-backed securities start running into trouble, right? And the issue is that at that point, it feels like nobody has any sense what this is ultimately going to do. Everyone thinks this is largely fine, right? And it takes years for people to realize that this is kind of embedded into everything. Everyone has exposure to this thing, right? And then I think it's actually kind of interesting how similar TradFi was to the DeFi crash, in that sort of at the time there was no mandated kind of tracking of who has derivative exposures to who in OTC derivatives markets, right? So the idea was everyone started blowing up, and only then were regulators wait, everyone has their hands in this pot, right? And then I think sort of you see the same thing, which is that sort of in various forms, right? Everyone, through derivatives, through weird kind of swaps, through structured kind of, I'm going to lend AAA to you, who's going to lend AAA to this, who lends into this tranche of this, who ultimately holds a sort of YOLO levered mortgage claim, right? And then you really, I feel see a similar thing here, where it's Luna goes down, everyone's oh shoot, that sucks, Ponzi down, we're all going to be fine, life goes on, right? It's it was underappreciated, the sort of systemicness of Luna, and how much the ecosystem has been, I think, very connected through basically the Luna is YOLO levered by some hedge fund and everyone else. and the hedge fund's YOLO leverage is sold to someone else, who's ultimately sold to like a Canadian pension fund, right? That is kind of investing in these YOLO levered strategies, promised like safe X% return, X being fairly high, not realizing they actually hold the downside risk. I think it's like hard to say sort of how much of it is, and I think it's totally correct as you say, there's multiple channels. There's this kind of credit risk channel of like something blows up and then sort of debt goes bad. And then there's what we call this fire sale channel of something blows up, people are forced to liquidate a bunch of crypto, that pushes crypto prices down, and then sort of the blow up of all the spreads also causes other people to blow up. So that's more like, again, this is like familiar in TradFi also, sort of in these times when volatility goes crazy and prices go out of whack, right? Sort of hedge funds and sort of like institutions that have nothing to do with the initial events can get in trouble basically because sort of hedge funds are effectively running strategies that print money with like high Sharpe ratios in good times, but rely on sort of prices behaving as they normally do. So this is more like an LTCM kind of event. LTCM takes like literally riskless trades, right? Or in a sense, like riskless if you have enough margin to hold it until expiration. LTCM is forced by the explosion of spreads to dump their positions on someone else, and they have to be bailed out, right? So LTCM is running stuff like you might think the ETH, staked ETH, STETH kind of trades, right? Like this is a good trade. If you can hold it forever, like you get paid. And the thing is, the guys who bought out LTCM's positions ultimately made a bunch of money holding them to maturation, right? And then so sort of I'm just like drawing a couple of analogies where sort of this stuff is simultaneously new to DeFi and quite familiar, I think. Sort of you see similar issues of sort of spreads exploding and blowing people out, non-transparent credit links between people blowing people out, and sort of all of this being quite non-transparent in TradFi as well. Sorry, that was a bit long, but that's sort of some links to draw between TradFi and DeFi. Yeah.
No, that's great. I think the parallels are quite striking, right? We're trying to build a completely new ecosystem that's supposed to have a bunch of qualities that TradFi, lacks. But then we end up building, I guess the interests are aligned in a certain way where however you build it, there is just going to be this interest of like, can I do more with my money? Can I gamble with a higher leverage? And then it all gets interconnected, like you said, and you see one thing blow up, and then we just don't know how far this goes. So like looking forward, are we at the end of it, or or are we at the beginning of it? I think it's very hard to sort of predict from where we're standing.
So one thing I'm not going to do is try and predict what's going to happen in the markets. I have no clue, I think, whether like this is the start or the end of stuff blowing up. So I'm not going to make any calls about prices or sorry how many other people are going to blow up. Yeah.
I think maybe Jared is going to feel comfortable doing that. Yeah.
Yeah, I definitely think that the market's going lower across the board, and even in TradFi and crypto, just everywhere. I think one thing that's really important, and maybe Anthony, you can expand on this after. I think people, especially in crypto, right? Because people think that crypto is a lot about your feeling, and is this going to go to the moon or is this going to crash? Like, I think there's obviously way more kind of intricacies behind where the price of something is and where it's going to go. And I think, for example, like interest rates have a huge effect on that, and also kind of monetary policy, because you look at the correlation, for example, between Bitcoin and the Nasdaq, and it's just like super, super high now. And I think it benefited from the effect of stimulus, and there was a lot of easy money, and debt was cheap. And now it's kind of we're going into the sort of reverse cycle, and that's kind of coming around.
Can I just add to that before Anthony replies? So like,
Yeah, sure.
I think initially the thesis was, okay, so we have Bitcoin. Bitcoin's going to be like gold, so it's going to move, in a different way than the market's going to move. And now we see that it's like obviously the whole market is super correlated with the stock market. And sort of my thesis looking at it is, well, Bitcoin is maybe not that important. I know everyone tracks it, and it's the biggest asset right now. But I think we're building a second stock market on blockchains. So like I look at a lot of the projects that are being built out, and to me they're just like companies, right? So we're just listing, in my view, companies on a market that everyone can invest in that's unregulated. So it makes sense to me that we are going to be in the future very correlated with the stock market, because we're building the stock market 2.0. And do you have any thoughts on like any of what we just touched on?
Yeah, so I think like on where it's gonna go, I mean the old argument, I mean I'm in Chicago, so I have to do this is really the question is it priced in already, right? And sort of like all the macro calls, it's just I mean, it's correct to the point that the market hasn't already priced it in, right? And so I think that's hard to call. With respect to like, is Bitcoin an inflation hedge? I always kind of felt like the people kind of say two things and I feel like they equate them and I think they're not exactly equal. People kind of say Bitcoin is an inflation hedge and then they take that to mean that on a very high frequency time horizon, right? Bitcoin should co-move negatively with inflation, with stock market, so on and so forth. It's not entirely clear to me that's like that equality makes sense. Like you could have Bitcoin as like in the very long run a hedge against inflation, right? Without sort of it having good short run properties at the horizon of like months or something like that, right? Like in the limit, buying this stuff, like it can't inflate or it can't deviate from a fixed monetary policy, right? So you're guaranteed to have a semi-fixed amount of stuff, right? In the medium term, right, there's enough noise in our measures of inflation that it's not entirely clear that in the medium term it's a good hedge against, say, monthly, yearly kind of inflation, right? And as to like why it's beta is so high, why it co-moves so much with the market, Bitcoin, and I think the crypto market in particular. I mean, I think for better or worse, I think that we are perhaps heading towards a world in which DeFi has real value. I don't think we're there yet. I think DeFi largely currently is a machine for levering up crypto, right? And functionally, like essentially the entirety of the DeFi market does one thing, which is take people who want to go like YOLO long crypto and then sort of allow some people who want to provide credit to the YOLO long guys um, to sort of provide credit and allow the YOLO long guys to get as much leverage as they can. And you look at any product in the DeFi ecosystem, and they're functionally like everyone is doing something that allows you to do that, right? And in a world like that, I mean, of course you're going to have correlation with the market, because the thing is like if you believe that like aggregate like risk on risk off sentiment is driving the market, um, that's also going to move crypto prices. And then sort of to the extent that DeFi is a machine for doing the YOLO long trades, that's going to drive the value of those things also, right? So I think it's like not surprised. Like DeFi doesn't have enough utility right now. I think that sort of thinking of fluctuations in the perceived utility of the coins and such, to me, is an explanation for why there's this correlation. My view is basically sort of risk on, risk off is driving most of the value of these coins. Yeah.
I think it'd be interesting to discuss Celsius 3AC and Solend. I sort of have thoughts on the last two. I don't have a lot to say on Celsius. I don't know if you guys have any thinking on that.
Celsius feels to me like, I think, two things. Like the mechanics of what happened there look to me, from the information I've got on Twitter, basically like a fairly classic bank run, right? So I don't know exactly what strategies they were running, but the hearsay is that some of the strategies they were running were like sort of profitable but illiquid strategies, right? Like hold it for long enough, the stake ETH trade, you're going to make a return, but you can't really liquidate it in the middle. And then so you're doing liquidity transformation, you're saying, give me your deposits, I'll give you back your money whenever you want, right? And then you're deploying it in a trade where I actually can't get the money whenever I want. And you're relying on sufficiently few people wanting their deposits back that you don't have to liquidate your illiquid trades, right? And so I feel like this is a somewhat classic event, which is kind of, yeah, if you have a bank and sort of the bank is doing maturity liquidity transformation, then the bank is vulnerable to runs, because like once a couple people want their money back and the bank has trouble, everyone else is like, oh shoot, I didn't actually want my money, but if I wait, I'm not going to be able to get my money, so I want my money too, right? And the old solution in TradFi is deposit insurance. Like it's a clever solution, which is basically everyone is guaranteed that their money is insured. And the insurance makes it so that the insurer never has to pay out because there's never a run event in the first place. So deposit insurance is a clever solution in that sense. Is it in that it fixes us at the good equilibrium where everyone waits until the stake ETH matures and sort of we get the return from that trade, instead of going into this prisoner's dilemma where we all sort of want to get out first and then kill the trade in the process, right? So I feel like there's some classic theory here, which is like, this is why deposit insurance exists, right? And I'm not saying necessarily that Celsius should be regulated like a bank, should have deposit insurance. It's just the mechanics of what happened here are very much a run. Sort of some part of it looks like a run on a maturity transformation strategy, basically. And I guess like the other angle though, which is more like potentially regulators want to look at this and think about sort of maybe we should do something here, right? Is that it feels like the fact that you have these institutions, this whole CDFI space, right, where it's kind of I'm going to create a very nice website and sort of say we're gonna give you like X%. What were they promising? I forget. Like totally risk free, and they hire people and put suits on and go to these TradFi institutions and sort of like sell to these guys, right? I feel like that's kind of again, it kind of has like '08 kind of vibes of you kind of like slap labels on things and sort of you do enough convincing and you can get people to buy. So I feel like I differentiate between two kinds of things, right? Like take Ohm, right? For Ohm, like a lot of degens bought Ohm and lost a bunch of money on Ohm, right? Like I put I think 1,000 or so in Ohm and I don't think I have much of that left, right? But look, like no legit institution would have gone on some website with a weird cartoony mountain, 3-3 weird game theory shit, and like actually put money in that, right? So in a sense, it's like sort of live by the sword, die by the sword kind of people got screwed in that event, right? And it's like, look, if you like were dumb enough to put your money in a bunch of like cartoon 3-3 with whatever, right? That's on you, right? I feel like the real risk of CDFI is that there's a segment of the space, which I mean, to be kind of blunt about it, right? Like, if you like wallpaper the degen side with a nicely designed website, you can get money out of those guys. And I think that's more dangerous because people who really didn't know who they were getting into, pension funds, like in the Luna case, like retail investors and stuff, they get sucked in and basically like tricked with these kinds of things. So I feel like the boundary on which like regulators should maybe jump in and say like, look, this is not so great is that look, I'm like basically like I'm at Chicago. I'm like somewhat free market-ish. I'm like, look, degens want a degen, lose money on GameStop, whatever, go ahead, you know. But sort of I feel like the part of the space where Canadian pension funds end up getting exposure to DeFi that they don't really understand is a point where maybe something's got to be done. So I feel like the economics of it are relatively sort of known, this run dynamic. I feel like the sort of marketing kind of angle of this of CDFI is this interesting space where sort of there's enough of an informational disconnect between a bunch of TradFi sort of money doesn't really understand what's going on here, and they're kind of the target audience for this kind of stuff. I feel I don't know exactly what the regulation would look like, but that seems like something that regulators should be a bit more concerned about here.
What do you guys think about 3AC?
So on my side, I feel like 3AC is I mentioned the '08 kind of situation, and I feel like transparency was an issue there. Like the issue with '08, I think the lesson the regulators kind of one of the many lessons they took away from there. I mean, they had lessons about like don't let people buy crazy stuff, right? That was one lesson, right? But the second thing is like have monitoring infra in place so that when people buy crazy stuff, we track it, right? And so like derivatives like monitoring infra was hilariously poor in the run up to '08. And then afterwards, I think one thing they did was they made it so that any OTC derivative agreement between parties had to be reported, right? I feel like transparency seems to have been an issue with 3AC, whereas like we're still in this fog of war where we have no idea who really has exposure. Just this morning, it seems like somebody else reported exposure to 3AC and looks like they might be in trouble, right? And then this allows things like, I mean, the hearsay, I don't want to like spread rumors and all, but the hearsay is that sort of like 3AC would basically like take funds designated for one purpose and use them for something else, like doubly pledged collateral and stuff like that, right? And it's like, that shouldn't happen, right? And sort of there's a question of like if the market lets it happen, should regulators go in and just say like we're going to make it so that that can't happen, like we're going to create a collateral registry or something like that, right? And I feel like transparency, like there's a question of would we have lost anything, or would we have lost a substantial amount if there were regulation or standards in place such that 3AC had to be more transparent with its leverage connections, right? And then sort of I feel like there are potentially some gains if at least someone had a handle on how much 3AC was borrowing from who, and sort of like ex ante regulation on the most problematic things that 3AC was doing, like in treasury management and stuff like that. I mean, ex post, they're going to get in trouble for this stuff. Like, it looks like some of this is like borderline, yeah, you shouldn't have done that, and they're going to get in trouble. But then it's kind of a puzzle, like, should we have let that happen in the first place? Right?
Do we know if 3AC was borrowing from decentralized platforms or centralized platforms?
I mean, what I've heard, like on Twitter, it looks like I mean, they're kind of borrowing from everyone, right? They're borrowing, like, apparently, like, people claim they're borrowing like from Treasury. They were like managing trades for lower fees for people and effectively using that as credit also, so on and so forth, right? So
Because it does feel like the Celsius meltdown and the part of what's happening with 3AC is sort of this, it's the lack of transparency, it's the lack of having everything on chain. It's more of a centralized finance issue than a decentralized finance issue.
But then would you agree with the sentiment that regulators should just like shut down CDeFi and then we're all fine letting everything happen in DeFi? Because if you really think that this is not DeFi's problem, you should be okay with shutting down any effort. Like you should be okay with regulators banning 3AC, banning Celsius, and banning anyone else who is not a pure DeFi entity. So I mean, you can make that argument, but functionally, like part of the growth of DeFi is in the growth of CDeFi, and I don't think sort of if you like DeFi and DeFi's development, you actually want regulators to do this. So I mean, I feel like this is mixing two arguments: the philosophical argument that DeFi is good, and the practical reality that sort of the market has developed in a way with a lot of entities like claiming and having a hand in DeFi, but really being centralized, sort of TradFi-like non-transparent entities, right? So I'm sympathetic to this argument. Some of the good things about DeFi, technically speaking, it has this transparency, it has these kind of things, right? But sort of DeFi is a social concept as much as it is a technical concept at this point, right? And sort of the question is, do we think of ourselves as being in the sociologically defined boundaries of DeFi, a set of people who have hands in both the TradFi and the DeFi legs, or the DeFi part, right? And so like I'm sympathetic to this sort of, but do you actually like, is the solution then to basically say we should never have a set of institutions that have legs in TradFi and DeFi anymore?
One of the questions that I have is like, why has there never really been any questions asked about why these places are not transparent, right? It took until they blew up until people asked questions.
Yeah. But this is familiar. I mean,
Yeah,
the
of
thing is, in
course, of
08, you
course.
have a similar effect where it's like sort of people stop asking questions when giving mortgages because the thing is, your margins are thin. Everyone's like making tons of money, right? And the more questions you ask, like the less mortgages you make, right? And I think like the mode for regulation is like the market does this, and it does this frequently, which is that when everyone relaxes standards and you're a portfolio manager, right? You have two choices, right? Like lose to the YOLO guy, or sort of like match his degeneracy, right? And so I feel like the market, like in hindsight, easy to say, right? But this happens again and again and again, right? And then the forces are fundamentally the same, right? I think that sort of when things are going well, you look like an idiot for not getting free 20% from Anchor, right? Like I talked to someone who was investing in Anchor, and then like they looked at me like I was an idiot for not putting money in there, right?
I
And
never
then sort
touched
of,
it, and I never wanted to touch it.
yeah, and I mean, like, easy in hindsight. But 3AC were looking like geniuses right until the day they blew up, right? So, I mean,
I think
I feel like,
there could end up being something like a kind of a shockwave effect, because I know that 3AC has invested in a lot of sort of crypto startups and new tokens, and I'm
Yeah, they might
wondering
have to
if
sell
maybe they
everything
have
to-
some like vested tokens somewhere sitting that they maybe don't have access to yet. If those tokens become available to them, they could start crashing other projects because they're trying drastically just to get all their money out
Absolutely.
of everything.
Yeah. So can we move to Solend? Any thoughts on Solend?
I think like Solend is, I think, philosophically quite interesting because of this idea that like central bank like functions of like we're gonna go break the rules to rescue the market, right? They're starting to emerge in DeFi. It's like central banking in the US at least emerged as consortia of banks like privately started talking and occasionally would rescue each other. So central banking was not so much imposed from above as you see a similar process of development. It actually like emerged organically from private, largely private entities. And so you kind of see, I think, like again, counter to the ethos of DeFi, strictly speaking, to say we're going to nationalize a large position and then do what we want with it to save the ecosystem. But you see the market forces pushing to do this, right? I mean, I feel like sort of pushing. I guess like talking a bit to this like philosophy of like I feel like a lot of people discuss like this is the spirit of DeFi. This is not the spirit of DeFi, and people take these things seriously, right? But I think like what people forget is like government is not something which is opposed upon us from above. Government is something we put together like it emerges from social organization, right? It's like nobody. Well, I mean, Solana is, I guess, a bit different in the sense that like there's large institutional involvement, right? But like Ethereum, Bitcoin, like decentralization emergently centralizes and creates entities that are powerful enough that they become governance bodies effectively, right? And so the thing is that sort of once they become centralized, then we define them as the enemy and want to decentralize more, right? But this is like a natural process, right? The market leads towards forms of things that look like governments, things that look like central banks, right? And then sort of, I think like this is just to say that sort of it's a fuzzy philosophical line, like what is government bad, not free market, and what is kind of decentralized good free market, right? And then sort of the emergence of like governance entities from the ether of decentralization, I think illustrates that a bit. And the thing is, I feel like rather than value judgments on this, one can look forwards and say like, who's going to play this role? Who's going to be the centralized guy that breaks the rules sometimes, bails people out, right? And you kind of see like people vying to do this. So SBF is on Twitter saying like, I'm going to bail people out, right? I think that one interesting thing I think is that, I mean, there's these like rumors floating around that certain stablecoin protocols also sort of are doing certain things to sort of occasionally bulk up certain parties. I wrote a thread yesterday, I think, about how in a hypothetical world where Olympus was big, Olympus has the capability to print money and bail people out, right? Solana, of course, is like a more drastic change, which is like effectively breaking the rules of a protocol to bail people out and save people. So I think like philosophy of that is a bit like trickier. But I mean, I think ultimately like it's like you buy into a protocol with governance that can change rules, right? You're buying into the possibility that the rules will change, right? Like if you don't like it, like fork the protocol, like commit the code, like remove the possibility of the code changing and use that one instead, right? You take a strong free market view, I mean, you have that option, right? And it's like sort of people like upgradability, people like sort of governance, people like flexible parameters, and it's like a double-edged sword. It's like you have a contract that's upgradable, tunable, has kill switches and fail safes, right? And sort of the community ultimately can pull those kill switches and fail safes. And if you hold $100 million in it, like you have to worry that they have the ability to pull a switch and take your money, right? So I feel like the theme of kind of markets produce centralization, and sort of centralization wasn't imposed upon us. And we should expect decentralized markets to ever create sort of local sort of hills of centralization. And the philosophy of whether we should always stamp these down is very, I think, unclear to me.
I think it's definitely an interesting choice for them to make this decision to kind of lock up some whale's position. I wouldn't say that they don't have like the authority to do it. I mean, if the people who own the tokens who are running this system vote to make this happen, they're going to make it happen. But I definitely think that the choice to do this will hurt them in the long run. And essentially make it so that whales and other people similar to this, people who have this position, will not view this application as a viable option, which could hurt them.
Yeah, and
in terms of,
I
like,
hope I hope everyone learns from it, right? Like, so they're sort of in a real pickle because they let this huge position get deposited, and now if it gets liquidated, it's no one's going to be able to liquidate it because it's going to move the price too much, and they're going to be stuck with it, right? So they're really going to hurt their own protocol. But they made this mistake a while back, right, by letting this position happen. That being said, they can't really prevent it because the code's not set up to prevent it. So I think there needs to be a change in the way that borrowing platforms let money be deposited. And we've actually at Moremoney come up with an idea that we may or may not write into code. But the idea would be to sort of essentially tranche deposits if they reach a certain size. So you can't just deposit 20% of the float of a token onto the platform. You can do it in tranches that have sort of a different deal. We're calling this high liquidation price entropy lending. So I hate what Solend is doing, and at the same time I feel for them because they've already made this mistake. But I think every other protocol would have made the same mistake, right? Like, this is not coded anywhere. Like, this could be Aave.
Yeah, largely agree.
I think maybe this is a good place to stop. Anthony, thank you very much for joining us. I think it was a really interesting conversation. We'd love to have you back in the future. I think your point of view is like, and the way you sort of approach it, like there's not many, I think, academics who are in crypto, and I do hope it is the future of finance. So yeah, hopefully we can have more of these talks in the future.
Thanks a lot. It was very great chatting. I learned a lot from chatting with you guys. So yeah, thanks for having me on.
Awesome. And if you've made it this far, please like, subscribe, and follow us on Twitter. It would make Jared very happy. So
Very
thank you.
happy.
Have a good day. Bye.
Right.